Hello, working, guys. Alright, so I'm gonna try to make this one a little more quicker, even though the last one was absolutely beautiful. But they ruined it just like they ruin everything, so I'm not gonna let them get this one. At least for completeness sake. Uh, Fuck. But, yeah, so an introduction to an order block. So, what an order block is basically the up move before the down move, or the down move before the up move. So if you have a trend and it's looking like this, then it reverses like there, and you see this little up move right here. That's the order block. So price is going to break down from it, return to it, and then continue going down because smart money has to sell there because they sold there before. So what that looks like in real time in a live example is, look at this. So when you understand an order block, you understand the blueprints of smart money, like what smart money is really doing, right? But the thing about it is, an order block just alone, like say this is an order block as well. Yes, you have a reaction, but that doesn't mean it's going to go down all the way up here, right? So, for example, you have an order block down here, which is a down move before the up move, returns it into perfectly as well. We have an order block down here as well, up move. It doesn't return; it just comes down here and it keeps going up, right? And in other words, in other times, sorry. For example, here you have an up move, which is an up candle before a large down candle. So you expect if price was to return back into this area, it would be selling, right? It doesn't work here, right? Because it hits it, you have a little pause in price, but ultimately it just continues screaming up. So this is an invalid order block, but an order block is just a way of viewing price, and I'm going to see if I can remember how I explained the mechanics of it, because again, it was absolutely stunning. So fucking irritated, you know. That too they'll fucking take, boy. Ah. Anyway, so how do we basically an order block again is the down candle before the up move, right? Why is this important? Why is this down candle important, right? Because smart money is they buying in down candles, right? What do I mean by that? Okay, and how do we know smart money bought down below here? You see this happening right here? Oh yeah, look at all that too, I forgot. Oh. What this is a move that was filled with speed and magnitude, right? This is a move that was quick, it was fast, and it did something, right? It market moved with conviction, sorry. Yeah. So from this point right here, the market moved with conviction, right? And then it started consolidating again. So when we see this, we know smart money bought there. How do we know that smart money bought down here by seeing this? What does this tell us? What this tells us is, look at it like this, right? Smart money, or the composite man, I like that. The composite man is an entity with a lot more money than me and you will ever have or ever trade, and they're the ones that push price around like this. They cause these very aggressive moves with speed and magnitude. This is all driven by smart money. Why? Because they have a lot of money, right? So what that looks like visually, if the market is doing this, right, that means that the market is very quiet right now, right? But from the time this happens here, this happened because a lot of buy orders was placed into the market right here. At this point, a lot of buy orders jumped into the market at once on behalf of the composite man or smart money, and as a result, the market moved up aggressively, right? If you're not going to see a market like this and there's millions of dollars being pumped in, right? If millions and billions and trillions of dollars are being pumped in any market, not trillions, but you get the point. If a lot of money is being pumped into the market at once, the market is not going to consolidate like this. This is how the market is going to look like. Why? Because think of the market as an algorithm, right? It reacts to stimulus, right? If a lot of money or a lot of buy orders are in, the market is going to do this, right? If a lot of sell orders are in the market or the market's very heavy, the market is going to do this, right? And this is a very bad way of showing it because it just shows up and down moves. This isn't really what happens. So what really happens is moves like this. See this? At this point right here, because we have all that, we know that there was a lot of buying that happened right here, right? Because of the expansion, speed and magnitude, right? You're not going to see this kind of movement going on when there's a lot of money being placed. As soon as a lot of money is placed in the market reacts. Boom, right? Nothing. Little bits of money being placed in. Boom, right here. It's where all the money dumped into the market, and then they release the pegging that keeps the market under consolidation. That I don't know if that's true or not, but that's the way I understand it. And when they release all their money, boom, you get that extrapolated move right there. So those are like the blueprints that we see. Yeah, those are like the the blueprints, right? So the thing about it is, you have to understand that this is an order block, right? So what happened during here, like what also validated the order block, right? Coming back to what I was saying initially, right? Because we saw this reaction, that's what we call institutional sponsorship. If institutions are sponsoring this move, that means that they're putting a lot of their money behind the move. And if they put a lot of money behind their move and you get an up move that's aggressive like this, they're usually not just doing it for a little pop and to come back down and start to take all their money. No. What they do is, if they're buying, they're usually gonna buy again and then buy again, because we are in an overall uptrend on the 4-hour time frame, right? So we don't expect smart money to start selling from this point. We don't expect that. We expect to see continued buy moves, right? That gives us a bias, right? And the bias is basically up. Where? Up inside this order block. Why is this an order block? Because smart money, they sell. They buy in down candles. So in this down candle, at this teeny little point right here, smart money did it. They bought here, right? How do we know they bought here? Because from the time price entered here, there's a lot of speed and magnitude away from the area, or a lot of displacement. It's being displaced due to the large amount of orders that have been placed in this area, right? So the thing about smart money though is they can't get in everywhere they want to. No, smart money doesn't work like that. They don't just say, oh, well, let's go in up, let me buy it here, or let me buy it here, or let me buy it up here. They don't do that, right? Because smart money has to get in before the market moves, right? So if you see a price the market doing this and then this happens, you know smart money sold right here. Because as soon as they jump in with their orders, you have the big reaction of the marketplace. So how can we learn to anticipate where smart money was going to buy, right? Well, what smart money does is they have a little handicap, you could say. Because of this sheer size of their orders, for example, this could be like $600 million liquidated right here. Because of all that being there, they need people to buy from, right? Yes, they are a liquidity provider, but they are also a business. They provide liquidity for trading to facilitate trade, but they also are a business, and a business can only run and perpetuate if it has net profits at the end of their term, whatever term that is, right? So how does smart money make profits from here? If we go into a 50-minute chart, smart money makes their profits by counterpartying with other liquidity, right? Available liquidity, right? For example, you have liquidity below these lows, and then you have liquidity below here, and then you have liquidity below here as well, right? Why is there liquidity down here? Why is there liquidity in these areas? Because they are basically viewed by retail people as some sort of reversal, right? So an example of a retail person, let's just say a retail person got really, really good and he entered right there. Where would he logically place his stop loss? His stop loss would logically be placed down here, below there, because he, in his mind, if structure breaks like this, he's going to come out of the market, and that's going to be in the form of a sell order, right? Because the way Forex works is a zero-sum game, right? If you buy here and then price goes up to your take profit and you press close trade, what you're actually doing is selling the position that you bought down here, right? So if you're buying again and price comes down here and stops you out, your stop loss is basically a sell order, because you bought the dollar index here in this sense, because this is basically a chart. What we're looking at is a chart that explains or depicts the value of a certain asset, right? In this case, the asset is the US currency index, right? So given that, it's still a buy position, right? And the only way to exit out of a buy position is to sell it, whether sell it up here for a profit or sell it down here for a loss, right? So retail is like this, and they say they want their 1 to 3, and they have all their fib projections and whatever bullshit they use, or they try to use and understand, right? But so their take profit is up there. Retail doesn't understand that you should take profits and take partials and whatever, and as a result, there begins, because it's just not one person buying here, right? It's not just one person who has their stop loss down here, right? Not everybody's going to have the same take profit, because this is rather ambiguous, right? A lot of people could view it differently, but majority of people, when they learn to trade, even I myself do this, if I have a buy position, I want my stop loss below the low, because as long as price stays above that low, I'm good, right? So there's basically a lot, thousands and thousands of people who have stop losses below here. They have stop losses below here as well. Below that little low right there. They have stop losses here as well, right? So this little pink box, this is basically liquidity, right? And what liquidity in this sense means stop losses below here, and stop losses below here, right? So why is this important, right? Understanding the psychology of retail traders allows us to see where's liquidity. What is liquidity? In this case, this is stop losses. Stop losses for what? Or in other words, stop losses of buyers, which in turn are sell stops, right? Because they bought a position and then they have to get out of the position by selling the same position that they bought initially, right? So that means that in this market, currently at this point in time, where's the money? Ask yourself always, where's the money? There's money below here, there's money below here, and there's also money below here, because you see little kind of consolidation and an up move, right? So with that in mind, understand what I was saying before about smart money. They need counterparty to their orders, right? They think about it like a grocery, right? If smart money is the owner of a grocery, right, and they want to sell their goods, right, they need people to buy their goods from them, right? That's the mechanics, and that's how smart money operates. And knowing that is going to give you an introduction to liquidity runs and how to find them, and then realm theory and all this shit. But think about it like this. Smart money, or the composite man, basically owns this asset, right? He is the owner or the storehouse of the US dollars. The Federal Reserve is the central bank of the US currency, right? So the thing is, these at the central bank level, they are smart money. They are the composite man. They are the real people who manipulate price, right? And think about it like this, right? If they wanted to buy in this area, so if this was supposed to happen, that means smart money would have their buy orders here, right? But there's one problem. Smart money, if they want to buy here, how do they get people to be selling to them at this level, right? Always think about how is there going to be counterparty to the buy orders on behalf of smart money or the composite man. How do they do that, right? Remember what I just explained to you? There's sell stops below here, sell stops below here, and there's sell stops below here as well as here, right? Because people have stop losses down here in the form of sell stops. And think about it like this again, right? From a very, very fundamental level, outside of Forex and stuff, normal like bartering. What determines the price of any asset or commodity or anything? What determines the price? Ultimately, what determines the price is what people are willing to pay for it, right? Think about collectible cars, right? Or cars that haven't gotten popular yet, right? Back in like when the days that the 2JZ was, not the 2JZ, the Supra, right? The older Supra, think about the 240SX, think about all these older cars, right? Before they became popular, their value wasn't all that. But now, if you go and look, there's Supra selling for like $400,000 in my currency right now, right? because of what people are willing to pay for that. So, in coming back to Forex now, below here, there's a lot of people willing to sell at this level below there. A lot of people willing to sell at this level below here, and a lot of people willing to sell at this level below here. Oh fuck. And all these people are, what the fuck? Yeah. All these people are basically willing to sell within the order block that is going to be created, right? Nope. Yeah. So, what happens here? If the market comes down and it takes out these stop losses, what happens here? In actuality, the person who was in a buy position in this place and they're expecting it up, and then price inevitably comes down here and knocks them out of their position, what happens to their money? They lose their money, or their money comes out of their account, and as a result, their money is available, or their orders are available, or the money that they lost is available to anybody who's willing to buy in the order right there. Think about like trading orders, right? So retail has their orders down here in this area, and then when smart money comes, smart money buy comes down hard and then buys the available sell stops, right? So basically smart money is forcing people out of their position by going below here, and that basically they trade sells. This man trades a sell stop for a buy order right here, right? But in the case that this is a loss, he loses this money, and then this money that's now available negative from his account now is available on the positive on behalf of smart money, because they came, they knocked him out, and then his available money was transferred to them because they had buy orders up here, and they basically absorbed the liquidity down here, right? So by understanding all that, we can begin to see that what we are expecting is price to absorb liquidity below here, below here, below here, and below here, right? And the way we see that is right there, bang, right? Now, when we have institutional sponsorship behind a move, now I want you guys to look at something right now, right? Let me move back a little bit here, right? Look at the way price is being delivered right now. Look at the size of the candles. Look at the place. Price is kind of in a range right now. It's not really doing too much, you know? So, right now, what do we know? We know that there's no money in the market right now, right? There's no orders in the market right now. But look at the way the price changes, right? Price is still slow. And then look at this level. From right here, you see that? Look at that difference in speed right there. This is what I mean by speed and magnitude. Slower candles, a little bit of speed and magnitude, but still slow, small candles within a range. From the time it reaches here, from this up candle right there all the way down, that speed and magnitude, right? And then look at the difference in price action. Price action, when there's institutional sponsorship behind it, by means of this order block that was created by means of counterparty from this liquidity, this liquidity, this liquidity, and this liquidity. Smart money absorbed all that sell side liquidity and they placed in their buy orders, right? How do we know they placed in the buy orders? We don't know yet until we see price react with speed and magnitude, right? And we have the speed and magnitude right here, right? Look at this. Look at the difference in this between the difference in this and down here and up here and up here. Look at this. This is conviction, this is speed, this is magnitude, right? And if we look closely, the unbroken chain of price that just kind of ran into here, this is basically a run into support or capitulation, right? And capitulation happens when smart money, this is a phenomenon that happens a lot when smart money is willing to, is doing something, right? Whenever you see this kind of price action that's really unbroken and straightforward and fast, smart money is doing something, right? It's one or two things. It's either smart money is doing something or the algorithm is reaching for something. In this instance, look at this as well. If we draw liquidity right below here, right? Look at what the algorithm did. The algorithm stopped right here and then ripped right through it. That tells me, or that shows fingerprints of the algorithm, right? and then the following was this speed and magnitude, right? But this is your introduction to liquidity runs, right? What does this algorithm do? This algorithm, it hunts liquidity, right? In a very stunning fashion at that. So by the same token, you have liquidity below here, and then you have liquidity below here, right? I mean above here, right? So you have liquidity here and you have liquidity here. We can get rid of this because this might be a little confusing. Yeah. So look at this. The algorithm basically, we think of search and destroy, right? The algorithm seeks liquidity and then runs to it, and then has liquidity above here, runs through it, right? But then what's the mechanics behind here? Smart money is taking this liquidity below here, 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 and then here. Well, not, yeah, it took liquidity below here and it stopped right at there. So taking liquidity below here, 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 all these points of liquidity, right? Price ran to it. What smart money did? They bought from all the willing sellers down here because they were stopped out, and they bought from them, and then price is immediately running, right? At this point, smart money just presses the button. Smart money, the algorithm really takes its price into these areas, right? The algorithm does this, right? So when the algorithm does this, then the people who buy the books in the banks and the central banks, then they place their orders, right? And then after they place their orders, then you see this. But look at what the algorithm does from an algorithmic perspective, right? It takes this liquidity, right? Yeah. At this point, there is sell stops or stop losses below here, and then there's stop losses above here, right? We know this, right? So if, remember, Forex is a zero-sum game for everybody, including smart money. What does that mean? It means smart money has to get out of their positions too. And same way, smart money just can't exit positions whenever they want to, the exact same way that they just can't enter a position whenever they want to. What do they need? They need willing counterparty, right? And what does that look like? Willing counterparty looks like stop losses above here in this area, and then buy stops above here as well in this area, right? So basically, if you could map it out, what smart money basically needs to do is come down here, absorb stop losses so they can buy in this area, and then run up here and absorb more stop losses so they can start selling what they bought, right? Before continuing higher, because they want to get out of the position, so because they're basically trying to secure the bag, right? So since we know they're trying to secure their profits over here, and they need a valid counterparty over here, which is in the form of these buy stops, what they're doing is they're buying here in a position, and when they're buying from willing sellers in here, and then when it reaches happy and they get some of their profits and they want to secure some profits, what do? They sell the same position that they bought here, they sell it up here to who? To willing buyers above the marketplace or buy side liquidity, right? And understanding that is your beginning or your introduction to liquidity runs, right? Because in what I explained to you just there is basically a liquidity run in the mechanics of a liquidity run. So it comes down, takes liquidity, and then runs up, takes liquidity. And after that, we don't know what's going to happen, right? But because it's a higher time frame move, we can expect that they're going to take liquidity above here, and above here eventually, right? But if we look at it from an algorithmic perspective on the way the price actually delivered that day, look at this, right? Nothing, nothing, nothing. Price ran. Look at that. Smart money bought up here. And now where is targets for smart money? The liquidity above here. So this liquidity has been neutralized when this happened. Right? This liquidity down here is gone because it came to and absorbed the stop losses. And now the only available liquidity within a short range is up here. So what does the algorithm do now? It takes the liquidity, runs it perfectly, and after that, look at that. In stunning fashion, instantly you get your profit, zero drawdown, you good. That shows that the algorithm works. And after that, it kind of slows down, goes up a little bit, consolidates. Why is it consolidating? Because all this going on here is smart money unloading their positions right here, right? So they bought positions down here, and then when price gets up into an area of willing buyers, they spend a little time down here to unload the position or sell to the buyers and process their orders before continuing up. And that's an example of basically what happened down here, right? So with that understanding of liquidity, then we basically understand that price. Oh, also, remember, look at this. This is something I wanted to show you as well. You see how this very significant move, as I explained, is done? Like you basically price switch gears right here. And then you mark off the top and the bottom of where price switch gears, and this is on a 15-minute time frame. If you go on a 4-hour time frame, what do you see? This box is the same, but at the same time, look, top of the candle, bottom of the candle. This is your order block, and this is validated. So now what do we do with this? We basically just wait for price to return to the order block, right? Right? And then price return to the order block, and then it should flow off from there. Yeah. And then we get another buy opportunity, right? Price basically did the same thing when it hit this order block, I'm sure. Yeah. Took liquidity, came up, and then it took liquidity below here. Again, speed and magnitude, and then it went up. And then they did some unloading of their positions, went up, unloaded some more, went up again. And then this is some profit taking because it retraces, it doesn't consolidate. Consolidation in this instance or this narrative is unloading of positions at areas of liquidity. So all that is basically just saying how our order block forms, right? So I gave you basically the rundown of everything, right? So why I wanted to show you that is because today Papa ICT and me did the same thing. And this is something that I need to be documented. This is something I need documented now, because it's rather inspiring and encouraging for me as a student. So you see this here, this big jackass candle. Look at this bullshit, right? Look at this fucking bullshit, right? Now I initially bought down here. Why did I buy down here? Because again, liquidity. A quick liquidity pool being built, return into a fair value gap, and on the higher time frame, I'm expecting price to run again the liquidity above here. Right? This is on a 4-hour chart. The liquidity above here, I'm expecting price to go up to there. Right? But the cool thing about it is, remember what an order. Okay, so in real time, I bought here, and my stop loss is at break even here, just like all the Instagram traders. And I took it because I saw this liquidity being neutralized here. Boom. Speed and magnitude. If you go to a 5-minute chart, probably might get a little better. Yeah. So speed and magnitude, took out liquidity, and I bought somewhere in this area right there. And I was riding it up, got some nice profits. And then stop loss at break even. What happened right here is basically FOMC. This is a big news event that happens once a month, I believe. Yeah. Every month it happens. But what's interesting about this is that I knew everything, and Fatman, this is for you specifically, because now you're gonna see me like fangirling and shit. So, how much time we at? 28 minutes, holy shit. You see, they fuck up my thing, man. But yeah. What's cool is down here, there were stop losses, right? And as I said, I was in a position here and I put stop loss at break even and I got stopped out during FOMC, right? But the cool thing about it is I still saw, okay, this liquidity has been taken out, right? This liquidity has been purged. It was purged by this move, right? And then FOMC dropped. I know that on a higher time frame, price is willing to reach up into this liquidity up here and then this liquidity up here, ultimately, which it did, and then again, profit taken, unloading of orders when it hit to the higher time frame liquidity. But the cool thing is I was able to visualize that, okay, this liquidity down here is being purged, and so basically when the market looked like this, I was like, where's the other liquidity, right? The other only available liquidity at the time was below here, right? So when you look at it playing out, it looks better, right? Because it's like that, and it's like, okay, I see, you could have bought down here, you could have bought here because this is the formation of an order block and then it goes up here. No, I bought it down here That means on a 1 minute chart, this is what I saw. Oh, not even that. Yeah, this is what I saw on a 1 minute chart, right? Who in the right fucking mind is gonna see this shit? Look at this shit. Just down and say, yeah, I'm gonna buy right there. The reason why I was able to do that is because I fully understood that the only reason this is happening is because price is coming to take liquidity down here. And then when liquidity is taken down here, there's going to be a lot of available sell stops, right? So I literally bought the available sell stops as they were triggered into the marketplace. Just like how smart money does it. But the thing about it is I didn't understand that I was doing it fully at the time. It just kind of happened automatically because I already understand all these concepts and I just experimenting a lot right now. But this is something that's scary. Nobody, like before, I could have never looked at this. Just screaming down candle, going up and down, doing all that crazy shit, wide spread, and just say, yeah, I'm gonna buy right there. I would have never been able to do that. And yeah, as I said, ICT took the same trade the exact same time I was taking it, did the exact same thing. Targeting what? Targeting liquidity first of all above here. What happens? Price eventually hit the liquidity and then continue going up as well. I came out as my liquidity was hit right there. So this is, I think this is the candle, no, not this. Yeah, this is the candle that I exited on. So my buy order was from this point somewhere about here to up here, and I got a little 50, I actually got 40 something pips from it. So maybe my order was like further up here or something, but still that was just because of the spread and filling and everything. But I understood seeing that fast move down here, buy it right there, came up right there, came out right, yeah, right about here. Perfect execution. All right. And to me, seeing ICT doing that same thing, because even before I saw ICT posted, I kind of looked at us like, wow, I really felt good because this is basically a perfect trade in my opinion, right? And it's during a very high impact news like this. You know, much people would see this and say, yeah, well, I get fucked up today. But no, I understood the mechanics of what was going on and I operated this exact script that the algorithms operate on and smart money operate on. And that's just very encouraging, especially seeing ICT doing the same exact execution live hours after I looked at it and I felt good about it. So it's just very encouraging as a student to see this kind of progress. And yeah, the date is the 28th of July, 5:40 p.m. 2021. And this is where I'm at. It'll be fun to see where I'm at in I don't know, couple months, couple years. It'll be fun. Yes, nobody fuck it up today. I did a shitty job of explaining. I'm sorry. I stressed out.